Hi everyone, hope you're all doing well. I just thought I'd make a really quick Sunday video, talk about DraftKings. Obviously a major holding on mine, and it brought some news out, and I thought we'll just talk about what this potentially could mean for the company and why they're potentially making this move. Now, the really surprising thing is that I actually really got asked no questions about this, which I was really surprised about, because I thought with it being a potential bid and a bid for an acquisition that we'll look at, I thought a few people would be like asking me like, oh, is this good, this is bad? And I think the reason why I didn't get asked if this was a good or bad move is because if you look at the share price on Friday, it did absolutely nothing. It reacted nowhere near or do anything to this news that came out. And it was actually up on the day, and then it gave a bit back, but I mean, it was down 1.2%, and it's really nothing at all. There was hardly any move in the market from this potential acquisition, which was quite interesting. So once again, it just shows you that I'm sure if the share price was up, everybody would have gone, oh, wow, this must be a really good news. It must be a really good acquisition. And if the share price was down, everybody would go, oh, what's DraftKings doing that? This is a terrible move. It just shows you like how sometimes the share price will reflect people's opinions on it. And because there wasn't much reaction on the share price, no one had an opinion on it. But I'll give my opinion on it anyway. So DraftKings announced it did a superior bid for PointBet's US, that being the key bit, US assets. Now, they already had agreed to a $150 million bid from Fanatics last month, which we'll talk about that. And obviously they went to up it by offering $195 million. So when you actually look at PointBet, they're a company, a US sports betting, racing and iGaming company that operates in Australia and New Jersey. When you look at the company itself, it doesn't look a really healthy business, really. You know, you look at the business, it's not very pretty, and it can show you sometimes it can be a little bit tricky if you don't do it right to get profitable in this space. Now, why would DraftKings want to acquire this? What benefit did DraftKings have from offering $195 million for this business? Well, the reason more than likely is this. When you look at the online sports betting at the moment, and this is a little bit old since this time frame, this is obviously November 2022, and obviously we're at midway of 2023 at the moment, and DraftKings market share has been getting a little bit better recently. The reason why Flutter has a big market share over DraftKings is the parlay options, which we know DraftKings was like the number one target in 2022, which has obviously helped them. But you can see here FanDuel have a good 40+% of market share. DraftKings hanging around the 25% of market share as the time of this was taken. And you can see basically between them two, they own a good chunk of the market share. So really, DraftKings and Flutter are only really battling against each other. And where they've been taking a lot of market share, holding market share, all these little companies are battling out for the rest of it. And if you're outside of Flutter and if you're outside of DraftKings, and this is why I have these two as my companies, you know, the likes of BetMGM have struggled to keep up to that market share with the likes of these two companies, and you've got other ones here, you've got Caesars, Bet Rivers, Barstool Sports, and they've all kind of struggled and battling away from each other. And if the US market can be dominated by two players, or have the majority of the share between these two players, between DraftKings and Flutter, obviously them two are massively going to, for a major town like that, to only have two players would be absolutely amazing, and they will absolutely smash it. And that's what they want to do, really. They want to control a lot of the market share. They want to make sure they get everyone coming towards them. And DraftKings have always been aware of this. They've always been aware that we need to keep the biggest market share and keep the little companies battling away with each other, and we keep the majority. And I think FanDuel are as well. We've seen FanDuel make acquisition targets. We've seen DraftKings make the acquisition targets with like GNOG, for example. And this is obviously why probably FanDuel and DraftKings actually in 2016 wanted to merge. They wanted to merge because they thought, well, if us two can have the two brands and control the majority of the US market when it gets big, we're going to do really well. Unfortunately, this was actually blocked because of anti-monopoly, funny enough, believe it, in 2016. So it was crazy that was blocked in 2016. But even since then, you know, DraftKings have gone, all right, who's the third player in this sort of space here? The likes of BetMGM, you know, they own 12% of the market share. You know, can we disrupt BetMGM a little bit? Can we rock the boat a little bit where they start losing market share? And they seem to have done it about a year ago. So they offered a bid for BetMGM, and BetMGM did reject it. But the thing that they had with offering BetMGM the bid is that either they knock out a major competitor, but also between BetMGM, because that company is controlled by two different companies, and BetMGM, which is MGM and Entain. MGM want to buy the full stake of Entain. So because DraftKings keep offering higher money, if they wanted to buy more of the whole company, because it's only 50% owned, that means that MGM would then have to offer more money. And then if they're offering more money, that's going to put more pressure on the company on cash burn, potentially dilution, potentially debt on the balance sheet. So then it puts them in a worse position if they were to take full control, which is obviously really clever. And obviously from a 50-50 partnership, obviously if they're arguing about potentially buying each other out, or there's, you better not accept DraftKings offer, and actually we want to buy the rest of you out, and well, we don't want to take your offer because DraftKings offers so much, you offer. And it could also cause some friction between a 50% ownership between the companies as well. So it was a very clever move where either they take out the third biggest competitor, or it causes friction between the business, and maybe the business doesn't operate as much, or it means that MGM can't acquire the full stake from Entain. And obviously, as you can see here, maybe that is one of the causes why we've seen MGM it's done well, but it hasn't done as well as what potentially it could have done if it held on to its market share that it used to have of nearly 15 up to 20%, which is interesting. And also when you look at the new one, obviously trying to buy PointBet, why would they want to buy this one? Well, the business that wants to buy it is Fanatics. Now, some of you guys that are in from the UK, you might not know what Fanatics is. It's not as big over here as it is in America, but basically they sell a lot of merchandise, and it's quite a decent sized company. As you can see here, they raised some capital in December 2022. They were valued at 31 billion, which is nearly triple the size of DraftKings. And you can see here that they raised 700 million in fresh capital, and they were going to use this for M&A activity across the Fanatics platform. In particular, they were going to use it in collectibles, betting and gaming businesses, which is the big thing they were looking to enter. So they were looking to expand the business from this merchandise collectible kind of business into also gaming and iGaming, because they're saying, whoa, we can look at the money that DraftKings and Flutter are making. We want to be in here. We've got a major brand name, a customer base. We want to get in this space. So Fanatics want to enter the iGaming and the sports betting site. And obviously a company that's 31 billion with 700 million fresh in capital, obviously let's say they use 150 million to take out PointsBets, and that will be their starting platform for they'll probably rebrand it then to Fanatics Bets or whatever it is. They rebrand it there, and then they take already their customer base and all their technology already, so they don't have to start from scratch. And from there, they can use also, they'll still have, you're talking 550 million in free cash still to then pump out, marketing to, or they could use that 550 million for marketing, maybe for more M&A, get used on the platform, expand it into new states. They can use that cash to really make PointBets another competitor. So from DraftKings' point of view, they're worried about a company that is a big company in Fanatics, a 31 billion market cap company, coming into this space. And if you have another company that kind of takes 5-10% market share, obviously that's not good from DraftKings. Now, the point of view is that obviously if that was to happen and DraftKings let it be, Fanatics could use 550 million in marketing, and obviously the likes of DraftKings would have to probably use something similar in marketing to stop losing customers to Fanatics. And that's not what they want to do when they're focused on profitability. That's why they want to make sure they don't let Fanatics get into this space, or make it harder for them to get into the space. So rather than spending the likes of 200, 300, 400 million in marketing to compete with the likes of Fanatics, how about we make it harder for them to get into the market, and the company that they want to use as the stepping stone to build up an already built platform to enter the market, well, instead of using that 300, 400 in marketing that we'll probably end up in competition with them, how about we just make it harder for them? Let's just, instead of letting them have the company for 150 million, we take it for 195 million. And that's the reason why DraftKings are using that as a tactic that they've done previously, to make sure they maintain that market share, and in the longer term, potentially, that saves them on sales and marketing. And the good thing is with DraftKings at the moment, what do we know about them? They're smashing it. They're smashing it on revenue growth. We've seen them move more to profitability. Because they're moving more towards profitability, the cash burn's getting lower. They're going to have a good, I think it was 700 million cash available, I think they said, when they do get to adjusted EBITDA very soon. So from their point of view, they've got 700 million cash, so they've got the cash to easily pay it up and stop point bets from entering into this space. So that's probably what they're kind of thinking about it. Overall, my thoughts about it, I can understand why they are making this move. You know, in the longer term, it would be a good move to stop Fanatics from getting into this space. But even if they stop Fanatics this way, I think Fanatics are so focused getting onto this space because they see how much it's booming that if they go, all right, we can't get points bets because DraftKings stopped us, well, how about we go to someone else? Let's go to something like acquire the brand of Barstool Sports and try and get that off Penn National or something, or any other kind of platform. I think that they're still going to be, they are still going to be, even if they lose this battle, they will still be focused to get into the market. And I think it's one of those that you have to accept there's going to be companies that want to get into this space. You know, we've already seen the likes of like Disney identifying this as a major category in the next few years, and you've just got to accept it is a hot category and people want to get into it. It's like streaming. You know, for so long Netflix had the good control of streaming, and eventually everyone realised how good of an industry it was, and everyone went, well, Amazon getting here, and then the likes of Disney getting here, and all the other kind of platforms. So I think DraftKings have to get to a point of view where they don't want to just burn their balance sheet through to put off Fanatics, because they're probably going to get in here. Rather than using that 190 million in cash, could benefit them by slowly stopping Fanatics. I think they might as well just keep that for themselves. And if they see an acquisition target that they maybe actually really could use, then go for that. Or if they could potentially pay down some debt, then do that. Or whatever it may be. I think, in my opinion, I personally won't make this acquisition because I can understand why they're doing it, because they want to stop Fanatics getting in here and getting that stepping stone. But at the same time, even if they stop this stepping stone, I think Fanatics will look for the next one. And it will be inevitable that they will enter the space. So save your cash and maybe use that out somewhere else is what I would say. But that's the reason probably why they're trying to make the acquisition anyway. So yeah, overall, if they do acquire it, I wouldn't be too mad. It's not a major acquisition, and you can see why they're doing it. But in my opinion, I wouldn't make this move. In my opinion, as a shareholder. But hey, what do we know? There's people in this space a lot better than me that will have information that I'm sure Jason Robbins has a lot more information available about what Fanatics are going to be potentially lining up than what I do. So he will probably be the one to make a better decision than me. But yeah, that's what I think anyway, in my opinion. So I hope you enjoyed the video, guys, and I'll catch you in a bit.